India is now the fastest-growing major economy in the world. Output expands at a pace many countries envy. New highways rise, stock markets climb, global investors line up. And yet, at the same time, the Indian government distributes free food grain to roughly 800 million people. More than half the population depends on state rations to meet basic needs. This is not a country in recession. This is a country growing fast. So why does growth on paper fail to translate into security in daily life? Why do millions of young Indians step into adulthood without a clear path to stable work? And how did a widely celebrated growth story turn into a quiet employment trap for an entire generation? The answer is not hidden in a single statistic. It sits beneath the headline numbers, inside the structure of how growth is produced, how work is distributed, and how risk is absorbed. To understand that structure, the story has to slow down and look at the economic system India is actually running today. To understand why fast growth can coexist with insecurity, the story has to step back and define the system India is actually running. India today operates as a dual-speed economy. One part moves fast, plugged into global capital, technology, and modern services. The other moves slowly, tied to land, informal labor, and public support. These two speeds exist within the same country, but they rarely intersect in daily economic life. On the fast track are modern services, information technology, software exports, finance, telecommunications, and large infrastructure investment. These sectors drive headline growth. They raise productivity and attract foreign capital. But they employ a relatively small share of the workforce, and they demand high skills, credentials, or access to capital that most workers do not have. On the slow track is where most people live. Agriculture still absorbs a large share of workers while contributing far less to total output. Small, informal enterprises dominate non-farm employment. Street vendors, delivery workers, casual construction laborers, and seasonal factory hands. These jobs typically exist outside formal contracts. They offer limited stability, weak wage progression, and little social protection. This is where the concept of informality becomes central. Informality is not merely a legal classification, it shapes daily economic reality. Informal workers are paid when there is work and unpaid when there is not. They absorb economic shocks directly. When demand falls, income can disappear overnight. When prices rise, there is no buffer. In India, informality is not a marginal phenomenon. It is the dominant labor market condition consistently observed across labor force data and employment surveys. Growth inside such a system behaves differently. Output can rise through capital investment, technology adoption, and productivity gains without absorbing much labor. That is why GDP growth can feel detached from lived experience. It measures how much the economy produces, not how securely people live. This leads to a second distinction. Job quantity is not the same as job quality. Employment statistics may show millions working, while large parts of the population remain economically fragile. A delivery rider working long hours without insurance is employed, but still one illness away from crisis. A graduate working below skill level is employed, but not progressing. These patterns appear repeatedly in labor market studies and household surveys. The third concept is demographic pressure. India has one of the youngest populations in the world. Every year, tens of millions of young people enter the labor market. In theory, this creates a demographic dividend. More workers should mean more growth. In practice, it creates a test. If the economy cannot generate enough stable, productive jobs fast enough, youth becomes a source of pressure rather than momentum. This is why youth unemployment and underemployment matter more than headline averages. Young workers are the marginal entrants. They are the first to feel when ladders disappear. When they cannot find traction, frustration accumulates quietly, often expressed through delayed independence, prolonged job searches, or acceptance of unstable work. Finally, there is the role of welfare. Large-scale food support prevents hunger and stabilizes society. It plays a critical protective function. But it also signals something structural. When a fast-growing economy still needs to support hundreds of millions of people with permanent assistance, it reveals that market incomes alone are insufficient at immense scale. This video addresses 3 questions that follow directly from this structure. Why rapid growth has not created enough good jobs. Why inequality feels sharper even when some indicators appear stable. And why young people are the pressure point where this system is most likely to strain. To answer those questions, the analysis has to begin where the pressure is felt first, in the labor market faced by the young generation entering adult life. For India's young population, the problem is not simply finding a job. It is finding a job that leads somewhere. Official labor force data consistently shows that youth unemployment remains elevated even during periods of strong economic growth. For people aged 15 to 29, unemployment rates vary by definition and location and are typically higher in urban areas. But unemployment alone understates the issue. The deeper and more persistent problem is underemployment and poor job quality. Many young Indians are technically employed, yet economically stuck. They work in informal arrangements with no contracts, no benefits, and no predictable income. A delivery rider, a gig driver, a temporary office assistant, or a casual construction worker may be counted as employed, but their earnings fluctuate sharply. Career progression is limited. Skills often stagnate. One unexpected shock can erase months of effort. This is what turns employment into a trap. Education was once widely seen as the primary escape route. Families invested heavily in degrees, believing credentials would unlock stable middle-class jobs. Over time, however, the supply of graduates expanded faster than the supply of suitable roles. The result has been credential inflation. Degrees that once signaled upward mobility increasingly function as entry tickets to low-paying service work. Many graduates accept jobs far below their training, while others wait extended periods for formal sector or government openings that remain scarce, a pattern repeatedly observed in graduate employment surveys. At the same time, firms often hesitate to hire formally. Formal employment brings compliance costs, payroll obligations, and regulatory exposure. For small and medium enterprises, informal hiring remains cheaper and more flexible. This creates a self-reinforcing equilibrium. Employers rely on informality to survive. Workers accept insecurity to earn income. The structure reproduces itself. Young workers experience this pressure most acutely because they stand at the margin of the labor market. Older workers may retain existing positions. New entrants do not have that insulation. They cycle through short-term roles, internships that do not convert, or unpaid training schemes. Each transition delays financial independence, household formation, and long-term planning. There is also a geographic dimension. Many young people migrate from rural areas to cities seeking opportunity, but cities absorb them unevenly. High productivity service jobs remain selective. What expands more rapidly is informal urban work. Migration becomes movement without mobility. This is why frustration accumulates quietly. Growth headlines raise expectations. When effort does not translate into advancement, trust erodes gradually rather than collapsing suddenly. Young people adapt by lowering expectations, accepting worse terms, or postponing milestones, but the underlying pressure remains. The youth employment trap is not the result of laziness or lack of ambition. It is structural. It reflects an economy that generates output faster than it generates ladders. Jobs exist, but too many of them fail to build skills, stability, or dignity. And this leads to a harder question. If young workers cannot climb because the ladder is missing, why was that ladder never built at scale in the first place? In most economies that industrialized successfully, factories played a central role early on. They were not designed to be glamorous. They were repetitive, physically demanding, and often uncomfortable. But they served a critical economic function. They absorbed large numbers of workers with limited formal education and turned them into stable wage earners. Factories created ladders. Millions could step onto the first rung and move gradually toward higher income and security. India never built that ladder at scale. For decades, manufacturing has remained close to roughly 15% of total output. This has not been a temporary phase or a cyclical fluctuation. It has been a persistent structural feature across multiple reform cycles, trade regimes, and political administrations. During the same period, services expanded rapidly, while agriculture released labor without fully redirecting it into industry. This imbalance matters because manufacturing scales employment differently from services. A large factory can employ thousands of semi-skilled workers at once. A technology firm producing similar value may employ only a few hundred highly trained professionals. Both raise GDP. Only one absorbs labor broadly. India's growth model leaned early toward services. Liberalization opened space for information technology, business services, finance, and telecommunications. These sectors integrated India into global markets and produced globally competitive firms. But they did not create enough entry-level jobs for the millions leaving agriculture each year. As a result, the factory ladder never fully formed. Several constraints reinforced this outcome. Infrastructure gaps raised costs. Power reliability, transport bottlenecks, and land acquisition delays discouraged large-scale industrial investment. Regulatory complexity added further friction, hiring formally exposed firms to compliance burdens that many preferred to avoid. Fragmented land markets made it difficult to assemble industrial sites quickly. Global timing also mattered. When India opened its economy, East Asia had already established itself as the world's primary manufacturing base. China, in particular, developed dense industrial clusters supported by ports, logistics networks, and coordinated state support. Global supply chains consolidated there first. India entered later without comparable ecosystems already in place. The result was a manufacturing sector dominated by small, fragmented units rather than large, labor-absorbing firms. Many operate informally, limiting productivity, wages, and training. Scaling up remains rare. In some cases, firms deliberately remain small to avoid regulatory thresholds, even when demand exists. Without factories, the labor market lost a crucial absorber. When people exited agriculture, there were few places to go at scale. Services absorbed some, construction absorbed more, particularly during infrastructure booms. But construction work is cyclical and largely informal. When projects slow, jobs disappear. Manufacturing could have provided continuity. Its limited role widened the employment gap instead. This gap feeds directly into the youth employment trap. Young workers need roles that teach discipline, develop skills, and offer progression. In many economies, factories performed that role. In India, many young people moved directly from school into informal services or gig work, where learning curves are short and ceilings are low. The missing factory ladder also concentrates growth geographically. Industrial clusters generate towns, supply chains, and secondary employment. Without them, opportunity pools in a small number of metropolitan service hubs, leaving large regions behind. India has attempted to correct course through industrial promotion and manufacturing incentives. These efforts are visible, but rebuilding a ladder that was never fully constructed takes time. Decades without large-scale industrial absorption cannot be reversed quickly. And until that ladder exists at scale, the economy will continue to produce growth without producing enough stable jobs. When factories fail to pull workers in, another force must hold the system together. In India, that force increasingly becomes the state. Economic growth in India does not spread evenly across space. It concentrates. Certain regions move quickly, others move far more slowly. States that anchor India's growth narrative tend to share common characteristics: large urban centers, access to ports or major transport corridors, more reliable power, higher concentrations of skilled labor and educational institutions. These regions attract private investment, modern services, financial activity, and large infrastructure projects. Output rises faster, high-income employment expands, consumption follows. At the same time, vast parts of the country remain tied to slower-moving economic structures. Rural districts, landlocked states, and regions with weaker infrastructure struggle to attract industry. Agriculture continues to employ large numbers of workers even as returns decline. Small, informal enterprises fill the gap but rarely scale. Income growth remains irregular and fragile. This produces a two-speed geography. On one side are urban islands of opportunity. On the other is a broad interior economy that relies more heavily on transfers, subsidies, and migration. These two worlds exist within the same national system, but operate under different constraints and offer very different life chances. Migration becomes the connective tissue between them. Each year, millions leave villages for cities. They do not migrate because cities guarantee prosperity, but because rural areas offer even fewer options. Movement becomes a coping strategy rather than a pathway to advancement. Cities, however, absorb migrants unevenly. High productivity service jobs remain limited and selective. Manufacturing hubs capable of mass hiring are scarce. What expands instead is informal urban work. Construction, delivery services, street vending, and domestic labor grow rapidly. These jobs generate income but rarely stability or upward mobility. Urbanization without industrial absorption produces congestion without transformation. Informal settlements expand. Infrastructure strains. Housing costs rise. Cities grow larger, but opportunity does not scale at the same pace. Meanwhile, rural areas hollow out. Younger workers leave. Older populations remain. Local demand weakens. Schools, clinics, and local services deteriorate. This dynamic reinforces itself. Investors avoid regions losing human capital. Governments respond with transfers rather than structural investment. The geographic divide also sharpens perceptions of inequality. Growth becomes visible but inaccessible. A young person in a rural district can see urban prosperity on a phone screen but lacks realistic entry points into it. Expectations rise faster than opportunity. Even within cities, the two speeds persist. High-income neighborhoods exist alongside dense, informal settlements. Office towers rise near overcrowded housing. Growth is present, but unevenly reachable. The two-speed geography turns national growth into a local lottery. Outcomes depend not only on effort or skill, but on proximity to growth nodes. Mobility becomes contingent on location. This is not merely an economic pattern, it shapes politics. Regions that lag demand protection and redistribution. Regions that grow demand flexibility and investment. Governments balance between supporting high-return areas and stabilizing low-return ones. In practice, stability often takes precedence over transformation. And when geography locks opportunity in place and markets fail to absorb labor at scale, the state expands its role to hold the system together. When markets cannot absorb people at sufficient scale, the state becomes the stabilizer. In India, welfare is not a peripheral policy choice. It is a central economic mechanism. Large-scale food distribution, rural employment guarantees, energy subsidies, and targeted cash transfers reach hundreds of millions of people. These programs reduce hunger, smooth consumption, and limit the risk of social rupture. In that sense, they work. But their scale also reveals a deeper structural signal. A fast-growing economy should, over time, rely less on permanent assistance. When support expands instead of contracts, welfare shifts from a temporary bridge into a structural pillar. That is the paradox. Food support illustrates this clearly. Free or heavily subsidized grain ensures basic survival. It is politically popular and morally difficult to contest. No government can easily withdraw food from vulnerable households. Yet the breadth of coverage sends an implicit message. Market incomes alone are insufficient for a very large share of the population. This creates a delicate incentive structure across the economy. For households, welfare reduces immediate desperation. It lowers the short-term cost of job loss or low wages, but it can also reduce pressure to accept unstable work far from home, especially when the alternative offers limited improvement. Labor mobility weakens. Informality persists. For firms, widespread welfare can soften wage pressure in low productivity sectors. When basic subsistence is partially covered by the state, employers face less urgency to raise pay or formalize employment. Informal hiring remains the path of least resistance. For governments, welfare buys time. It stabilizes society without forcing politically difficult reforms. Land markets remain rigid. Labor regulation evolves slowly. Education and training systems lag labor market needs. Welfare becomes the safer option compared with restructuring systems that threaten established interests. This is not a uniquely Indian dynamic, but the scale makes it distinctive. Programs such as rural employment guarantees function as employers of last resort when private demand fails. They provide income continuity, but the work itself is typically low productivity. Skills do not accumulate. Mobility does not follow. The system prevents collapse but does not generate momentum. Over time, welfare masks underlying fragility. Consumption stabilizes. Extreme deprivation declines. Aggregate indicators appear manageable, but income generation remains weak. Growth continues at the top while vulnerability persists below. This is why debates around welfare remain polarized. One side emphasizes its necessity in preventing hunger and social breakdown. That argument is valid. The other side warns that without parallel job creation, permanent assistance slows reform and entrenches dependence. That concern is also valid. Both realities coexist. The core issue is not whether welfare should exist. It is whether credible pathways out of dependence expand alongside it. In India's case, those pathways remain narrow. Manufacturing absorption is limited. Formal services are selective. Skill formation struggles to keep pace. As a result, welfare expands to compensate for structural gaps rather than shrinking as those gaps close. This incentive structure shapes behavior throughout the economy. Firms optimize for flexibility rather than scale. Workers normalize insecurity. Governments prioritize redistribution over transformation. While welfare spreads downward to stabilize the base, a different dynamic unfolds at the top. As the floor is reinforced, wealth concentrates above it, reshaping the middle of the distribution. That brings the analysis to the final layer of the causes. At the top of India's economy, growth appears unmistakably strong. Wealth has accumulated rapidly among a relatively small group of business families, founders, and asset holders. Capital markets have expanded. Large infrastructure projects have multiplied. Corporate valuations have risen. These developments reflect genuine economic progress, supported by investment flows, market expansion, and policy support. But this concentration reshapes the structure beneath it. Inequality in India often looks muted when viewed through certain official indicators. Consumption-based measures, especially after subsidies and transfers, can suggest relative stability. Income measures may show only moderate dispersion. Wealth distribution, however, presents a far more uneven picture. Ownership of assets, access to capital income, and exposure to high-growth sectors remain heavily concentrated toward the top. This dynamic produces what is increasingly experienced as a middle-class squeeze. The middle class does not vanish suddenly. It thins gradually. Its share of national income grows more slowly than the overall economy. At the same time, key costs rise faster than earnings. Housing, education, healthcare, and urban transportation absorb a growing portion of household budgets. Savings rates decline. Financial resilience weakens. For earlier generations, the middle class represented momentum. Education led to stable employment. Stable employment led to home ownership. Home ownership created security. That sequence is now less reliable. For many young professionals today, even those with formal qualifications, progress feels conditional. Jobs exist, but advancement is uncertain. Wage growth lags living costs. Informality and temporary contracts extend into sectors once considered secure. Benefits erode quietly. This is not widespread poverty. It is sustained insecurity. At the same time, the visibility of extreme wealth sharpens perceptions. Luxury developments, high-profile business expansions, and billionaire rankings occupy public attention. The contrast between elite success and middle stagnation becomes more pronounced. Even when absolute living standards improve, relative position and future expectations deteriorate. This is where inequality becomes psychological as well as economic. People evaluate their situation not only by income, but by trajectory. When expected progress slows or reverses, frustration accumulates. The promise of growth loses credibility. There is also an important measurement conflict at work. Official indicators may suggest low inequality because they capture consumption after redistribution. Food support, subsidies, and price controls compress observed differences, but lived experience reflects income volatility, asset ownership, job security, and future prospects. A household receiving subsidized grain may appear stable in data while remaining locked out of upward mobility. Employment statistics show a similar gap. A person may be counted as employed even when work offers no ladder. Aggregate numbers hold. Individual prospects stall. This divergence between metrics and experience feeds distrust. People sense that the system is functioning, but not for them. Confidence in institutions weakens. Political narratives polarize. Elite concentration also influences incentives. Large firms and asset holders exert disproportionate influence over regulation, land use, and capital allocation. This tilts the system toward capital-intensive growth rather than labor-absorbing expansion. Over time, the economy optimizes for returns instead of inclusion. The result is a narrowing corridor. At the top, wealth compounds. At the bottom, welfare stabilizes. In the middle, pressure intensifies. The middle class becomes a buffer rather than a beneficiary. This is why inequality in India is not merely a moral concern. It is a structural risk. A thinning or insecure middle undermines consumption, social trust, and political stability. It weakens the foundation required for sustained growth. It also explains why confidence that inequality will fall meaningfully in the near future remains low among many observers. Not because redistribution fails entirely, but because the engines that broaden opportunity are not expanding fast enough. To determine whether this trajectory is inevitable, the analysis now has to widen beyond national borders. India's trajectory becomes clearer when it is placed alongside other growth paths. The most direct comparison is East Asia. Countries such as China, South Korea, Taiwan, and later Vietnam followed a broadly similar sequence. Large-scale manufacturing expanded early. Factories absorbed rural labor in significant numbers. Workers moved from farms into industrial jobs that offered higher and more predictable incomes. Productivity rose. Wages followed. Over time, a broad middle class emerged. China's model was not gentle, but it was effective at labor absorption. Tens of millions transitioned from countryside to factory towns. Manufacturing functioned as an escalator. Even low-skilled workers could step on and move upward gradually. When China later shifted toward services and advanced technology, it did so from a far higher employment base. India followed a different sequence. It entered globalization later and leaned early into services. Manufacturing never reached the same scale. Labor absorption remained shallow. Growth relied more heavily on capital, skills, and urban concentration. The benefits were substantial but narrow. Vietnam offers another useful contrast. With far fewer resources than India, it positioned itself aggressively as a hub for labor-intensive manufacturing. Garments, electronics, and assembly plants spread across provinces. Youth unemployment remained relatively low because factories hired at scale. India, despite its size and workforce, captured less of that labor-intensive opportunity. The comparison with advanced economies highlights a different distinction. The United States and much of Europe also experience inequality and job polarization, but they are anchored by formal labor markets and broader social insurance. Job quality matters more than job count. Healthcare, unemployment protection, and pensions reduce the cost of risk. Workers can move between jobs without immediate collapse in living standards. India lacks that buffer. Informality dominates. Job loss often means income loss immediately. Welfare covers basic consumption but not mobility or skill progression. The safety net prevents collapse but not stagnation. These structural differences produce consequences. First, youth frustration accumulates. When education fails to translate into security, confidence erodes. This does not always result in visible unrest. More often, it appears as disengagement, delayed household formation, lower consumption, rising risk aversion. These responses quietly weigh on long-term growth. Second, regional inequality hardens. Areas that fail to attract industry fall further behind. Migration increases without absorption. Urban pressure intensifies. Political demands shift from opportunity toward protection. Third, the demographic dividend weakens. A young population supports growth only when it is productively employed. Otherwise, it becomes a source of strain. Underutilized labor represents lost output and rising social pressure. Fourth, political incentives tilt further toward redistribution. As frustration grows, governments respond with expanded transfers. Welfare scales up. Structural reform becomes harder to sustain. The system stabilizes at a lower ceiling. None of this implies imminent collapse. India's economy remains resilient. Domestic demand is large. Institutions endure, but resilience is not momentum. International comparison shows that growth models matter. Economies that built broad employment ladders early found it easier to preserve cohesion later. Those that did not face steeper trade-offs. India still has time. Global supply chains are shifting. Firms are diversifying away from concentrated manufacturing hubs. The opportunity exists, but timing matters. The longer current patterns persist, the harder they become to reverse. Expectations adjust downward. Ambition narrows. Even successful reform delivers diminishing returns. With those risks in view, the final question becomes unavoidable. If the constraints are known and the comparisons are clear, what can realistically be done now? If India's challenge were slow growth, the response would be straightforward: stimulate demand, invest more, wait. But India's challenge is structural. Growth exists. The problem lies in translation. Output expands faster than opportunity. That means solutions must focus less on speed and more on direction. Some adjustments can occur relatively quickly. In the near term, the most urgent task is to connect young people to work that builds skills and credibility. Apprenticeships and paid training linked directly to employers can do this faster than broad education reform alone. When firms receive support to train new entrants, they become more willing to hire formally. Even limited wage support tied to skill acquisition can shift hiring incentives. Formalization incentives matter as well. Small firms often avoid formal employment because costs are immediate, while benefits are uncertain. Reducing payroll burdens for initial formal hires, simplifying compliance, and providing predictable enforcement can nudge firms toward formality without undermining viability. The objective is not rapid enforcement, but gradual normalization. State-level manufacturing clusters offer another practical lever. Concentrating infrastructure, power reliability, logistics, and approvals in specific zones allows scale to emerge. When factories cluster, suppliers follow. Towns grow around them. Employment multiplies beyond the factory gate. Logistics improvements play a quieter role but remain essential. Shorter transport times, fewer port delays, and stable electricity reduce uncertainty. When uncertainty falls, firms hire with greater confidence. These are 12 to 24-month moves. They do not transform the economy on their own, but they can alter momentum. Other changes unfold more slowly. Education quality remains foundational, not enrollment, but learning outcomes. Employers repeatedly report gaps in basic skills. Addressing this requires teacher training, curriculum alignment, and accountability. Progress is gradual but cumulative. Female labor participation represents another long horizon opportunity. Many educated women remain outside the workforce due to safety concerns, social norms, and inflexible work arrangements. Expanding participation increases household income and labor supply simultaneously. Land and labor institutions also operate in the slow lane. Clear land titles, faster dispute resolution, and predictable labor rules reduce investment risk. Judicial capacity matters. When contracts take years to enforce, expansion slows. These reforms are politically difficult. They challenge established interests and deliver benefits incrementally rather than immediately. But without them, short-term gains fade. From these choices, two plausible futures emerge. In one, India achieves a more inclusive expansion. Manufacturing and formal services grow more rapidly. Young workers find entry points that lead somewhere. The middle class stabilizes. Welfare shifts gradually from permanent support toward transitional assistance. Growth remains strong, but its social base widens. In the other, growth continues without broad absorption. GDP rises, welfare expands, informality persists, inequality perceptions harden, youth expectations adjust downward. The economy does not collapse, but ambition narrows. Growth becomes defensive rather than aspirational. The difference between these futures is not ideology, it is execution. India has the scale, capital, and global opportunity to choose the first path. The open question is whether incentives can be aligned quickly enough for growth to feel tangible before frustration hardens into permanence? That question leads directly to the final reflection. India's story today is not one of failure. It is a story of unfinished transformation. The country has demonstrated that it can grow. It has built globally competitive companies, expanded infrastructure at scale, and lifted millions out of extreme deprivation. It has secured a central position in global economic conversations. These achievements are real, but growth alone has not guaranteed security, dignity, or upward mobility for most people. The true measure of success is not how fast output expands, but how many lives become more stable because of that expansion. For a generation entering adulthood, work has become uncertain. Jobs exist, but ladders are missing. Welfare prevents collapse, but it cannot substitute for momentum. Inequality is not only about wealth at the top, it is about confidence in the future. Every economic system eventually reveals its priorities through incentives. If capital is rewarded faster than labor, wealth concentrates. If stability is favored over transformation, progress slows. India now stands at that inflection point. The choice ahead is not between growth and equity. It is between growth that narrows opportunity and growth that widens it. One path preserves headline numbers. The other preserves social cohesion. For viewers, the takeaway is straightforward but demanding. Headline GDP is not enough. Look beneath it. Ask where jobs are created. Ask whether those jobs build skills and security. Ask whether the next generation is moving forward or merely standing still. Understanding these dynamics is the first step toward changing them. If this analysis clarified how growth, inequality, and youth employment intersect, consider sharing it. Join the discussion. Question simplified narratives. Stay engaged with the economic forces shaping everyday life, because the future of fast growth will not be decided by speed alone, but by direction.